The money in your bank account may look like it's really there, but it isn't. This isn't an illusion, and it's not a theory. If every customer walked into their bank right now and tried to withdraw their cash, the system would collapse within hours because the money simply does not exist. This isn't a system failure. The global financial system was designed this way. It's a centuries-old trick that has become so normal, we barely notice it anymore. It's called the fractional reserve banking system, and it's the silent trigger behind global debt, inflation, and the illusion of wealth. Once you understand how it works, you realize that money is built on promises that can never truly be kept. To see this clearly, we need to go back to a time before our world ran on digital balances. In medieval Europe, people used gold and silver as money. If you were wealthy, you owned chests full of gold bars or precious stones you could trade with, but transporting bags of gold was risky and dangerous. So people began leaving their valuables with goldsmiths, people who had secure vaults. In return, they received a simple receipt stating that they could reclaim their gold any time they wished. Over time, people realized something. Using these receipts in trade was much easier than carrying actual gold. The receipt represented the same value. And here is where the trick we still use today was born. Goldsmiths noticed something. No one came to reclaim their gold all at once. If they had 100 customers, maybe 5 or 10 would show up on any given day. This meant most of the gold just sat in the vault, untouched. So they came up with a cunning idea. They began issuing receipts for gold that didn't exist. If they had 10,000 coins in the vault, they could issue 20,000 in receipts. They lent out these extra receipts at interest-earning profit from gold they didn't actually have. As long as everyone didn't ask for their gold at the same time, no one noticed. They had essentially created money out of thin air. And this was more than just a side hustle. It was a revolutionary trick. Once people began to accept paper promises as equal to real gold, money creation drifted completely away from physical reality. Banks were built on top of this very trick. By the 17th century, even governments adopted the system. When the Bank of England was founded in 1694, it wasn't created for the people. It was created for a different reason. The crown was drowning in debt from endless wars. The bank lent the government money that didn't actually exist, and in return, collected interest. This debt wasn't repaid with newly conquered treasure. It was repaid with taxes collected from the English public. Sound familiar? Because this is exactly what governments do today. Borrow money that doesn't really exist, then force future generations to pay it through taxes. America followed the same path. Early American banks issued notes backed by gold until they realized they could issue notes for gold they didn't have. Periodically, panic erupted, people lined up to withdraw funds. And when they discovered the money wasn't really there, banks collapsed overnight. But instead of ending this fraudulent system, governments strengthened it. To support the illusion, they created central banks. The message was clear. Even if the money doesn't exist, we will do everything to make the public believe it does. Now let's bring this to the present, because fractional reserve banking feels abstract to many people. Imagine you deposit $1,000 into a bank. It looks like the money stays in your account. But the bank was historically required to keep only a small portion of it, usually about 10%, meaning the bank kept $100 and lent out $900. Someone spends the $900. A store deposits it into another bank, and that bank also keeps only a fraction and lends out the rest. Your $1,000 multiplies through the system until it becomes nearly $10,000 in circulating loans. But here's the critical point. Out of that $10,000, the actual cash is still only $1,000. The rest is debt. If this surprises you, here's the bad news. This story is outdated. Today in the United States, the reserve requirement isn't even 10%, it's zero. Since March 2020, the Federal Reserve no longer requires banks to hold even a single dollar in reserve against deposits. So what stops banks from lending infinitely? Not reserves, but international capital and liquidity rules known as Basel. After the 2008 crisis, central bankers in Basel, Switzerland, created rules, not parliaments. Loans create deposits, not the other way around. When you take a mortgage, the bank doesn't pull cash from a vault. It simply types new money into your account. That money exists only because you promise to repay it. That's why more than 90% of all money circulating today is not real central bank money, not cash, not reserves, but bank-created money that does not physically exist. In the modern system, money is created the moment someone goes into debt. This system has three inevitable consequences. 1. Inflation. Money loses value because banks multiply the same dollars over and over as loans. Prices don't rise only because of supply and demand, they rise because the currency itself is losing value. 2. A perpetual debt cycle. The total debt in the system is always greater than the amount of money available to repay it, because money itself is born as debt interest, guarantees one thing: somebody must default or borrow again. 3. Concentration of power. Banks collect interest on money they never actually possessed. Governments finance wars and spending without raising taxes. The wealthy hold assets like real estate and stocks, which rise with inflation, while ordinary people struggle with falling purchasing power. When the system falters, the illusion cracks. In the 1929 Great Depression, banks had lent far beyond their reserves. When trust evaporated and depositors rushed to withdraw money, it simply wasn't there. Thousands of banks collapsed. In 2008, the same pattern reappeared. Banks multiplied mortgage-based loans, creating a housing bubble. When the bubble burst, the system nearly collapsed. Again, government stepped in, printed trillions to save it, because modern economies cannot function without this trick. Today, the US, Europe, the UK, Canada, and Australia have no reserve requirements, all rely on Basel rules. Countries like China, India, and Brazil still have reserve requirements, but Basel capital rules apply to them too. What truly limits money creation isn't cash in the vault, it's rules written in Basel, Switzerland. And here's the unsettling truth. The system cannot survive if everyone becomes debt-free. If all debts were paid off today, the money supply would evaporate, credit would collapse, and the economy would implode. This illusion survives because you keep borrowing, keep spending, and keep believing the digits in your account are real. This is why knowing history matters. The goldsmiths' trick evolved into the core of modern finance, and the danger remains the same. When trust breaks, the system collapses. So what should you take from this? First, money is not real wealth. Real wealth is land, resources, skills, knowledge, and independence, things that don't lose value when paper promises collapse. Second, debt is not as harmless as it seems. It's a mechanism designed to work against you. Third, inflation is not an accident. It is built into the design of the system. This isn't a doomsday prophecy. It's a warning. If money is created as someone else's debt, then your freedom depends on your ability to step outside that cycle. History doesn't repeat itself exactly, but it rhymes. Medieval goldsmith tricks, 19th century bank panics, the 2008 housing bubble, all reflections of the same story. Making promises beyond reality and relying on people to believe them. And this story isn't over. Every major financial crisis proves one thing. The system survives not because of gold or productivity, but because of trust. And trust is the easiest thing to lose. The next time you check your bank account, remember, most of what you see exists only on paper created not for your freedom, but for the survival of a debt-driven system. If this gave you a new perspective, don't forget to subscribe.